If the Fed is cutting because the labor market is deteriorating, that's not necessarily a good sign. And I certainly don't think it's an all clear to buy stocks. It's a challenging situation because we've been saying for the last couple videos that we're sort of favoring bonds, at least for the duration of 2025, in lieu of stocks. Now, of course, we still own stocks, and stocks have done well over the last couple of months. But I think I feel exactly the same way, regardless of whether the Fed has already cut just last week, is projected to cut 3 more times between now and March. The Fed saying that they're going to cut means that rates are going to be going down on the front end. Hopefully, what we've seen so far is that the long end of the curve has also cooperated, which is good. It's good for bonds and it's good for the housing market. I think there's a world in which bonds do pretty well and stocks maybe do okay. They don't have to fall apart, and we get a little bit of boost to sentiment around housing. So maybe the next 6 months, rates come down a little bit. Maybe there's a little bit of refi action, and people start to get more interested in upgrading their house or moving. And stocks, I think, it could muddle through, meaning they don't really go anywhere. That would be a best case scenario in my view. This is really where the additional fuel for the fire could come from. All of this cash that's been sitting on the sidelines comfortably for 2, 3, 4 years. I think there's over $7 trillion sitting in cash alternatives, money markets, T-bills, CDs, this sort of thing. People have gotten comfortable getting 4.5, close to 5% in some cases, risk-free, short-term. And that I think this is really what the Fed's announcement has done, is it announced an end to that. Regardless of whether or not the labor market is deteriorating, the real reasons that the Fed is finally cutting, what it does from an investment standpoint is it reduces this beautiful risk-free option. With 100 basis points of cuts kind of baked in between now and March, all of a sudden, people that were getting 4.25, 4.5% on their cash, now it's going to have a 3 in front of it. In some cases, potentially even a 2 in front of it. That's a lot less compelling. And I do think that will drive either the next leg higher in stocks, or it will force people to go further out on the yield curve. And so people who were sitting in cash and short-term T-bills, they'll have to go, park their money for a little bit longer period of time. That will put downward pressure on the yield curve, which that's been a concern. Or it'll force people to look at other types of assets. So high yield bonds, corporate bonds, preferred stocks, real estate, private loans, there's all sorts of other things. So that is definitely something to pay attention to. I will say that I'm grateful to have a sliver of an allocation to gold and or gold mining stocks. And the reason for that is really just sort of, it's a hedge, and it's sort of a hedge against the unknown. Historically, people have said gold is a great way to hedge inflation. And then there's a whole nother group of people that says gold is a hedge against deflation. It's also a hedge against the dollar weakening because gold is priced in dollars. So if a dollar is worth less, gold is just inherently worth more because it's priced in dollars. I don't know for sure why gold has rallied so much. It may have something to do with the fact that crypto has also rallied. They're sort of thrown into the same basket. It's like this alternative asset currency type thing. It's a finite resource, and I can tell you why gold mining stocks have done so well, and it's because there's a break even for those companies that operate. They're mining for gold, and then they're bringing it into production, and if gold is below a certain price, it's not profitable for them to do so. And if it's above a certain price, it can be profitable for them to do so. And then if it's even higher than that, it's wildly profitable. So there's sort of leveraged ways to get exposure to gold, both up and down. Some people call it it's a hedge against war and just global uncertainty. It's done really well. And if you've been lucky enough to own some, I think it's probably not a bad time to take some profits, for a variety of reasons. One, things just don't go up forever, and we also may be at a little bit of an inflection point for the US dollar, which has weakened about 10% and is potentially set to reverse that trend. I can speculate on what is causing the speculation. I guess it's just there's maybe too much money out there. People are bored with the returns that they can get in the stock market. I'm sure not, but I think maybe it's people that aren't investing for retirement. They're investing for entertainment. That's my best answer. I don't think serious long-term allocators of institutional money are getting involved in meme stocks. Crypto, perhaps, a percent or 2% allocation, just because it seems to be proving itself as an asset class. And I think the origination of crypto came as just distrust of the system or of fiat currency. The U.S. is not the only government that's printing money and in a great deal of debt. I think that is where the Occupy Wall Street movement started during the global financial crisis. And that was really the emergence of crypto, which is sort of like, oh, we need an alternative to the traditional currencies. I don't personally believe that to be the case. Currencies are not a store of value. They're meant to lose value over time and drive some degree of inflation, which is helpful from an investment standpoint. Money has been easy for a long time, and people are bored with the returns of traditional assets. I think that will change. This is an interesting time to talk about what could go right, and it's also interesting that I think we're going to deviate a little bit from traditionally we talk, as we're investment advisors, we talk about stocks and bonds and registered securities. And I think there's still plenty that can go right in capital markets. I think stocks could certainly levitate a little bit higher before there's some sort of a meaningful correction, and bonds seem to have stabilized. But I think really with regards to what could go right, with the Fed embarking on a cutting cycle, I really think that there's an opportunity for things to go right in the housing market. Things have been a little bit locked up for the last couple of years. Transaction volume has gone down. Refis, nobody has had any reason to do a refi the last couple of years. Taking a HELOC to do an improvement to your home, a young family maybe wanting to upgrade, move to a slightly larger house, that's really kind of stalled the last couple of years. And I think it's possible that we see some movement there we've already started to see some, like you said, we've hearing from mortgage brokers who are starting to see some volume in requests for refis. Now, of course, rates aren't where they were 5 years ago, but we've seen 75 basis point reduction in the 30-year fixed. That's meaningful for somebody who's been on the sidelines for a few years. I think that is maybe the next thing that can go right in a big way, is a thawing of the housing market, some support for prices, and people that have maybe been renting longer than they want to or waiting to buy the new house. I think that's a place over the next 6 months where you could see some meaningful movement.